Ladies and gentlemen, we have another guest, our second guest speaker, our last guest speaker for the moment at least. And it's very important to have a political scientist here because he explained to me how naive economists are about this. Simon Johnson, the former chief economist at IMF, just wrote something in the Atlantic, which said basically it's all Goldman Sachs' fault, and that's all the decisions were being made to maximize Goldman Sachs. He said, no, political scientists are much more subtle about this, and his estimate it's only 95%.
96.
96, sorry. So it's a great pleasure to have Mark Blyth here. We're happy you came up, and apparently he's going to go move to Cambridge, so he can be around more often. Not necessarily this class that he wants to be around more often, but it's a little more interesting place than Providence, Rhode Island.
That could get me into trouble with my employers at Brown if anyone said that it was less interesting than Providence, or more interesting, so that won't be true. Hello. Thank you for the invitation. Can you all hear me? Yes. For those of you who have probably noticed by now, I have an accent, which is not your standard accent you're going to find around here. I actually have the same accent as Shrek. So if you have any trouble at all tuning into me, when you look at the video later, just watch a few minutes of Shrek first, and then everything will fall into place after that. A little bit of background about me then, to get us started. I sometimes describe myself as a lapsed Catholic and recovering economist. But you can also be a sort of a lapsed economist and a recovering Catholic. And both of them are actually the same thing in a very deep and profound way, which is they're both fundamentally concerned with uncertainty. And they both tame it with dogma. So what I'm going to talk today is how financial reform rests upon a series of financial ideas, which are themselves a form of dogma. And that's going to be part of where we go today. Back in 2002, I got interested in this stuff a long time ago, a decade ago. I'm much older than I look. And you may remember there was a thing called LTCM, long-term capital management. Right, well, they blew up. Helicopters on the roof in Greenwich and all this sort of like exciting stuff. And I thought, this is interesting. And I had no idea what this stuff was, so I started reading about it. And, you know, I had a fair background in economics, so I was able to pull some stuff together. And I started to get interested in how banks measured risk, particularly value at risk models. And I started to look into that, and I got even more terrified. So I did a couple of pieces around 2002, 2003 that said that this type of stuff's probably going to end badly. And of course it didn't. It just continued on, and people were making 60 times median income and so on and so forth. So it was great. You know, Blythe, you're an idiot. You don't know what you're talking about. Forget about it. And then the world blows up. And then suddenly people start to say, maybe there was something in this. So one of the people that I know you've read is Nassim Taleb, right? So basically Nassim and I are pretty good buddies, actually. And I learned a lot from him because he was also someone else who was saying this stuff is crazy. So if you like Taleb, you're going to like what I've got to say. If you think he's an idiot, you're going to think I'm an even bigger idiot. So that's the caveat, and we'll begin there. So let's see, what have we got? Political economy, future regulation, bouncy castles, uncertain risks, and the pitfalls of reform. I saw the syllabus you guys have, which is incredible. I would actually never have the nerve to actually assign such an interesting syllabus. It's far too interesting for a class, so you know this is great. So I'm going to basically try and take some of the stuff that I know you've done and put it around the issue of financial reform. I'm going to set it up by looking at the 1930s a little bit, and then come back to that at the end. And then I'm going to talk about some issues to do with current attempts at reform in the EU, in the UK, the US, and then hopefully bring this together in a kind of theoretically interesting story. So here we go. Given I wrote this last night, who knows how it's going to work out? Let's see. There we go. This is a bouncy castle. There we go. And I think bouncy castles are a great metaphor for what we're doing with financial regulation. Because if you've ever seen a bunch of 6-year-olds in a backyard, you know that one of them's going to find a stick. And that means another one's going to lose an eye. That means that somebody's mother's going to get bent out of shape and all hell's going to break loose. So what do? You disarm them and you put them in a large bouncy castle and they get to bounce around together and not hurt each other. That's what we're doing in terms of financial reform. Oops, sorry, going the wrong way. Where's this thing? There we go. But before we do that, back to the 30s. So there you go, nice picture of the 1930s. There's Roosevelt going to the left and Mussolini and Hitler going to the right. Somewhat appropriate. Now, one of the ways to think about this is the notion of crisis. A crisis is an interesting thing. If I was diagnosed with a terminal disease, that would be a crisis for me, but not really for anybody else. If someone drove a car through the front of my house, that again would be a crisis, but it would also be completely unexpected. So crisis is a weird sort of thing, and there's a lovely German word which describes this. Any Germans in the audience? You can own up to it, it's okay these days. No? Dämmerung means dusk or dawn. It also means decisive intervention. And there's that moment whereby dusk looks like dawn, dawn looks like dusk. Well, put this in the context of a crisis that didn't quite amount to being the terrible disaster everyone feared that it could be. And are we now facing dusk, or are we now facing dawn? And it's a very similar thing to what happened in the 1930s. Because in the 1930s, we had several crises that were interlinked. There were exchange rate crises, trade crises, the inability to restore the gold standard at the parity that the Brits wanted to do, deflation, inflation, hyperinflation. But the main thing that happened was, of course, deflation. Now, if you think about deflation, it creates an interesting set of dynamics. Imagine that you have wages and prices. So let's say you have deflation. What just happened to the real wage? Went up. Did anyone give you a pay rise? Nope. What's the biggest fixed cost facing business? Labor. So how do you survive? Cut. What does that do to the price level? Everyone's first best strategy fails. Every move to protect yourself makes the situation worse. It creates an extraordinarily uncertain environment. And in those moments of uncertainty, policy making jumps. It doesn't evolve, it isn't the next step in the time series, it becomes radically different and open to possibilities that hitherto were unthinkable. So if you think about the 1930s, you get some interesting outcomes. Germany, locus classicus of hyperinflation, followed by terminal collapse and deflation. Let's blame the Jews, and then we'll eliminate labor to save the market. Russia, of course, was already blaming the capitalists, had eliminated them, and had eliminated the market in order to save labor. Spain and Italy had blamed the communists, cartelized the market, and included labor. And the United States, who we'll do a little bit more on, blamed finance and then cartelized the market, decided this wasn't actually going to work, and then gave up on this and invented deficit financing. France went through several rounds of internal deflation to save the franc. Interesting little story about France. The Bank of France basically ran the place, regardless of what the Popular Front thought they were doing. And in 1940, just before the Germans invaded, the French generals went to them, the Bank of France, and said, we need to mobilize. And they vetoed it because they feared that it would undermine confidence in the franc. In Japan, they had 2 rounds of super deflation. Government campaigns through the newspapers, media, radio, the whole thing, essentially saying the problem is deflation in the world economy and we're export dependent and prices are falling. So what we need to do is to do a super deflation and get below, and then we'll actually be much more efficient than everyone else. And of course, that will take 30% of GDP out in about 6 years. Well, we didn't try hard enough, so let's try that one again, shall we? And then at that point, Taisho democracy collapses, the military takes over, and you end up with imperial expansion. So lots of different outcomes from essentially the same material conditions in a moment of profound uncertainty. Oops, I keep getting this wrong. I use a Mac, that's my excuse. Now, blaming finance in the USA in the 1930s. Why would you blame finance? Well, there was the 1929 crash. There was the problem with over-leverage. There were margin loans, investment trusts investing in other investment trusts, manias, and then panics and a large liquidity crunch. Sound familiar, anyone? And the results of this were, of course, the 1933 regulations of the Securities Act, the Banking Act, particularly Regulation Q, the banning of paying interest on time deposits, interest rate ceilings, the Glass-Steagall provision separating commercial investment banking, in a sense, making the system boring, making the system unbelievably safe, putting finance in a box. Now, the interesting point of this is there was a clear target. We know they did it, we have decided they did it, and we're going to put them in a box. They're to blame, this is how we fix it. And what was the diagnosis of the crisis that came after finance had been put in a box? Round 1 from 33 to 35, the National Industrial Recovery Act, which was based upon, as far as we can tell, the ideas of administering prices, that is to say, the problem with monopoly, a la the Brandesians, was not that there was too much of it, that there wasn't enough. That in fact, we needed more coordination of wages and prices because we'd built all the plant and equipment we were ever going to need. We had overcapitalized, and therefore we need to cartelize and regulate. If this sounds a bit like Italian corporatism, it is. And that's what we tried first. And it didn't work, and it broke down for good old-fashioned political reasons. Labor was meant to take most of the hit. Profits were meant to be saved in a declining market. One was zero-sum against the other. Round two was more interesting. Out of nowhere, consumption maintenance, Social Security, the Wagner Act, unemployment insurance, public works, followed by World War II. Massive government expenditure with finance in a box. And nothing succeeds like success. The interesting point here is the outcome's radically underdetermined. That is to say, there was very little in the material circumstances of the United States at that point would either select either of those sets of ideas or lead axiomatically from one to the other. It's that unintended variance that we need to explain and also need to pay attention to. Now, this brings up an interesting distinction. Which world was the 1930s and which world do we live in now? So I spent quite a lot of time thinking about this, probably too much for anyone's good. And you can kind of divide state spaces or probability spaces of the world in two ways. The first one is the world of risk. This is the one that basically banking presumes. It's the one that most economics presumes. It's the way we like to see the world. So I'll just run through some familiarities for you. Probabilities are knowable. There is a time series. There's always more data. Just by existing a day longer, you know you have more information. More information is better than less. Large N is better than small. And with the appropriate tools, you can basically crunch it and find out what's going on, and within certain variances, figure out what's meant to happen next. Ergodicity and outcomes. Given all those millions of sample histories, they converge to some sort of natural mean. This means that over time, there's a certain amount of stuff that happens in the middle of the distribution, which is boring, and then as you get out to the tails, the more radical things happen less and less and less. This also means a stationarity in the time series. One way to think about this is if the world was a roulette wheel, you're only ever going to throw the numbers on the roulette wheel. You're not going to have someone throwing in a tartan-colored ball and then 112 is one of the numbers. Given that what happens in the sample path tracks determines what happens in the next sample path. Programmable state space, that is to say that there's a definite algorithmic procedure for producing a result given the environment in which one operates. So simply by either Bayesian updating or experience or some other methodology, one can figure out in a sense the parameters of the world that you live in, even imperfectly, acknowledging they change over time, but you get more information over time. The problem then is incomplete information. That is to say the world is there. There is a materiality to it which is definite. And our problem is that it's opaque. So, given all of the above, we can have more information and strip away the fog of ignorance. We can get rid of opacity and see the world as it really is. So we get closer to the truth because of these prior statements. Given this, it means in a computing sense, the world is Turing programmable. Again, there's a definite procedure to get closer to the world as it really is. And in this world, Laplace's demon rules. That is to say, if you actually have knowledge of all the positions and all of the particles and all of the forces, then you can look back, and because of time reversibility, go forward, and then say what the world's going to look like. It's a very comforting world. It is the world that economics would love the world to be, and it is the world that Catholicism promises. And like Catholicism, it might be a lie. A world of uncertainty. This is my Talebian side. I love Nassim. He's a great guy. He's completely insane as well. A world of uncertainty. More data makes you stupid. How could that possibly be true? How could more information make you more blind rather than make you more smart? Well, one way to think about this is the difference between signal and noise. You can simply pump up the volume, but are you actually hearing anything better? You might actually want to look at things. Think about the following. Ben Bernanke to this day says that he can't see an asset bubble. Exactly. I'm surprised by this. My grandmother, in fact, my cat knew there was a housing bubble all through the global economy, and I'll show you the figures to prove it in a minute. So quite how he couldn't see this, I don't really know, but you have to be looking for it, I guess. The world jumps. What does that mean? Let's say 40% of movements in the dollar-yen exchange rate over a 25-year period happened on 0.21% of the trading time, or 13 days. That is not a normal distribution. If you had sold a long call option in 2008, say around August, when the Dow was at 14,612, saying that it would be at 6,500 within 6 months, everybody in the world would have bought you because they would have thought you were nuts to sell such an option. And you would have cleaned up the entire global money supply. Very few things in the world, turns out, actually are normally distributed, or just accretions of the same old time series. Most of the action happens in the tails. Structural breaks, likewise, are normal, and the state space is essentially random. The more you figure it out, the less you actually know. So one way to think about this is a literature in political science on the varieties of capitalism, and it basically, some of you might have come across this, it says there's LMEs, liberal market economies, and then there's coordinated market economies, and the two of them are kind of functional adaptations to a globalized environment. Yeah, right. And over here there's a thing called China, which is consuming all the world's resources. And that's going to radically change the state space for these two other things that are over here. So if you're simply looking at these two equilibrium sets and you're completely ignoring the other massive changes in the environment, you're going to be completely blind to what's happening in the rest of the state space. Lenny rules, that is to say, Ellen rules over there, I should have said, things are equilibrial, linear in terms of causation. Causes are exogenous, think dinosaurs and meteors, and things are normally distributed. Other side, well, nonlinear, deeply endogenous, not normal. And I forget what the other one is. We'll keep going. Information is not the problem in the sense that opacity is the problem. It's the problem of computability. If the state space is random, you don't know what to do with the information. So what do? You revert back to type. You revert back to what you've seen before that might possibly mean this. So any information that comes in has to be programmed to a set that you already know, regardless of whether that's what the information is actually telling you. In other words, without a theory of what things are, which is not discernible from the data itself, you don't know what the data can tell you. Finally, the world is emergent. What does that mean? When we get to CDOs and CMOs, I'll tell you, and it gives you a very nice illustration of this. And finally, Black Swan's rule. There are no demons. That is to say, you will be surprised, and that's the only thing that you will know for sure. Now, so which world do we inhabit, and how does this apply to the current crisis and reform efforts? Here's an interesting table. The modern Dämmerung, dusk or dawn. A crisis of liquidity, a crisis of capital, or a crisis of confidence. Just as the Japanese, the Germans, the Americans, the Swedes, and everyone else had to decide in the 1930s what this was a crisis of, beyond deflation being an obvious fact, what did that mean? What are we going to do about it? Who is to blame? What exactly is the problem here? We've got the same thing going on now. So let's have a look at the United States. Capital, these are responses to the crisis, immediate responses. And this doesn't mean this all been spent, by the way. This has just been what's promised, the whole thing. 4.6% of GDP in capital injections, 5% of the American $14 trillion GDP. That's a chunk of change. That's quite a lot of capital injections. Purchases of assets and lending by the Treasury, that's the bit no one noticed. That was the bit that was bigger than the bailout, where they turned the Fed into a bad bank. That figure has since risen to about 4%. Central bank support provided with Treasury backing, that's called quantitative easing or printing money. We did very little of that, actually, despite what the gold bugs will tell you. But look at this one. 41% of GDP committed to liquidity provision. So what's the definition of the crisis? There was a liquidity crunch. So what do you need to do? You need to throw liquidity at it. And if you throw liquidity at it, what's that saying about the underlying mechanisms and the way the system's set up? Well, essentially, it's fine. It's just run out of liquidity. So let's have a look then at the Brits, because they've got a very different response. 3.9% of a $4 trillion or $3.5 trillion GDP, so that's pretty similar. Purchases of assets and lending by the Treasury. Holy God, let's have a look at this one. That's Northern Rock, Bradford and Binley, all those things that went bang. That's direct recapitalization. That's government ownership of the financial sector. And it's over 1/8 of GDP. That's really been spent. Central bank support provided by Treasury backing. That's quantitative easing. That's printing money. So that's 25% of GDP, basically, they've really spent on doing this. Liquidity provision, zero. This is not a crisis of liquidity. This is a crisis of structure. This is the way the system is put together. We need to rebuild the institutions themselves. Now have a look at the Germans, because they're always different and very interesting, especially if you're Greek at the moment. You might have noticed this. Capital injections, 3.8%, in line with everybody else. Purchases of assets, not really turning themselves into a bad bank, fiscally prudent. You'd expect the Germans to be this way, of course. Central bank support, Treasury back and liquidity provision. Nothing, and 18% on guarantees. What's the definition of the crisis? Here it is. For a whole year, they thought that they were better than everyone else because we didn't have a housing bubble. Then they found out that their land banks had bought all the American stuff like everyone else, the state banks, and their private sector owned lots of condos in those really hot places like Riga. Now, as you've done in this class, so I'll be very quick with this, some common and not wrong explanations of the crisis and why they miss that variance in what those crises are being diagnosed as. And to anticipate where I'm going with this, of course, what you're going to see in the reform proposals is basically liquidity, confidence, capitalization. So, here's what you know already. 3 stories, 2 local, 1 global. The first one, the Greenspan put. Too much cheap money too many times. And it is actually kind of interesting that for years and years they spent all this time writing about the strength of independent central banks and free lunches and all this sort of marvelous stuff you were going to get, and you could be strong by demonstrating credibility without punishing and all that sort of stuff. And yet, actually, the best central banker in the world decided we could never have another recession ever. That's not in the script. The subprime trigger. That's it, essentially. Mortgage-backed securities, CDOs, CDSs, get triple rated, originate to distribute, excessive leverage, add a shock, serial correlation and deleveraging versus through model homogeneity and mark-to-market pricing. If anyone asks you what the crisis was, that's it in one sentence. Walmart dollar recycling and global savings. Of course, you know this one. I like to call this one the new monetarily assured destruction as opposed to mutually assured destruction. For 25 years, we got a great game going with the Asians whereby they would sell us real stuff like televisions and we'd give them bits of paper bearing 2%. That's done. For consequences which are going to be very, very large in terms of American wages, which is something I'll get to at the end. But there's also something else going on. This is the bit that Ben couldn't see. What are some other less obvious conditions that speak to this more uncertain world? The ability to have things blowing up right in front of you and still not see them. To have information in the set that you deliberately discount. To not want to hear the bad news that the fire alarm's going when the casino is getting really interesting. Here's an interesting thing about asset classes. How many asset, given that 40% of your school will go into finance, you'll all know this, I'm sure. How many asset classes are there in the world? Which is?
Just one, they're all correlated.
They're all correlated. But if you had to be a little, you're too clever for me. Be a little bit nicer to me. How many are there really?
Debt, equity, real estate, commodities.
So you 4, right? Let's say that debt and equity are basically fungible equivalents in a portfolio, reciprocal relationships in a class, right? So you got all sorts of paper, and you got real estate, and you got commodities. That's it. Now, it's interesting you got these things because when you put finance in the box in the 1930s, they didn't get to play with that stuff, did they? And then in the 1970s, that box got opened up with the collapse of Bretton Woods. And then at that point, the private sector picked up the huge market and exchange rate risk that was suddenly there, out of which you get the emergence of complex finance and so on and so forth, and you can see where the story begins to go. But an interesting part of this as well is to do with pensions. Because what you also get is the privatization of pensions and the rise of institutional investors, all chasing something very interesting, a moving average. Because how do you get rewarded in the financial sector? You have to beat a benchmark. Doesn't matter if you're sitting on a desk in a bank or you're running a fund or whatever. There's some kind of benchmark, usually an average of performance over the period, 12 months, 6 months, whatever it is. Now, let's say last year I did really well and I made 10%. And I made 1% over the benchmark. So that's great, and I get my nice little reward for doing that. What do you think is going to happen to everybody's benchmark next year? So everyone else has to then meet that benchmark. Now, if we're all investing in the same asset class at the one time, what's going to happen to the amount of risk we're taking in the portfolio? But don't worry, because your VAR numbers won't show this, because everybody's doing it at the same time. So you've got a huge moving average problem, plus integration, plus globalization, all looking for a buck in a limited number of asset classes. What does it look like? Here's your stock market bubbles. So the first one, the green line, is the Japanese stock market bubble. Right at the peak there, of course, was when the Imperial Gardens in Tokyo were worth more than California. That actually happened. That's not a joke. That's how insane that was. And then, basically, you get a decade-long recession, in part because the Bank of Japan's trying to play a strict monetarist line, and everybody else is trying to do something else. The people have lost faith in the government and the bureaucrats and everyone else, and when you spend money, they take it and stick it in the mattress, compounding the deflation. Then you get the FTSE. So from 2000 up to the tech stock bubble, down, ride, yeah, it's a reasonable amount of appreciation, up to 6,000 at its peak. And then, of course, let's have a look at the DGIA. Of course, there's been enough economic growth of, let's say, I don't know, 3 standard deviations from norm to justify that, clearly. Of course, there wasn't really a housing bubble. On the left-hand side, you have the places that didn't have a housing bubble. They're the ones that blew up in the 1990s. They're called Japan and Hong Kong. Everyone else had one that was so obvious, you would need a clown with a giant drum marked housing bubble coming in and banging it in order to convince me this wasn't a bubble. And remember, these things are averages. Right? So you're talking about houses where I grew up in Dundee, the Flint, Michigan of Scotland, right? The armpit of Britain are going up fast as well, for no apparent reason. The city's depopulating and the house prices are going up. This makes no sense, let alone what's happening in the posher parts of the City of London. So let's have a look. United States, about 80%. Britain, well, 160% in 10 years. That's perfectly reasonable, isn't it? Ireland, 190%. The Celtic Tiger, what a load of rubbish. Giant bubble. So you move from one asset class into the other. You start to get worried about stocks after 2001. Where's the smart money going? Oh, and when you've got one last asset class that are really, really small, what happens to the price of oil in 2007? All together now. Green line's housing. Blue line is stocks, and the purple line's commodities. Now, it was all a bubble. We all know that now, and we all love Keynes and Minsky and Taleb, right? So if that's the case, why are we paying so little attention to what these theorists actually said in current reform efforts? So let's have a look at what's on the table at the moment, as far as I can figure out. The US reform proposals, lots of them going on, very ad hoc, no real steering, simply because of this insane thing Americans are addicted to, the Constitution. Can you get rid of it? I mean, it is the most dysfunctional piece of technology for running a country the world's ever seen. It's like, oh, the genius of the Founding Fathers. What? To basically make sure nothing gets done? The one guy with a plan can't introduce legislation. The only people who can introduce legislation are the people who are bought and paid for. And the only people that can actually call this stuff are the lawyers, and they have no interest in doing either of the other two things. Makes no sense to me. But then again, I study Sweden. What do I know? Anyway. So nobody's really in charge, and lots of people trying to do things. So what's the House Financial Services Committee bills? Well, first of all, have ratings reform, right? So we've got to get rid of those raters. Terrible. And that's going to go nowhere. The Systemic Risk Council. This is what the Europeans have gone for. I like to call this the Jedi Council solution, because we all know how successful they were at guarding the Republic. We're going to have shutdown powers. Right? The wonderful thing about shutdown powers, living wills, all this sort of stuff, this is really brilliant, right? Because think about how absolutely nonsensical this really is. So let me say, you're a huge bank, right? You're 15% of like all assets and deposits in the United States, and you're in trouble. So we send around the guys, it's like the new G-men, right? So we come in the door and we look and say, you're in trouble, so we're going to shut you down. We're going to kill you. Yeah, right. You're really going to do that, aren't you? Right. You're really going to walk in, you're going to shut down Goldman Sachs. Now, let's say that that was even possible. Let's say somebody had a rumor that that was going to happen, because you know that that's going to happen. What are you going to do to that stock the first possible opportunity? Short the hell out of it. And the minute you short their paper, what's everyone else going to do? You're going to bring out the very collapse you're trying to avoid. The thing makes no sense. It's internally incoherent. Promotion of centralized counterparty clearing for derivatives. I'm all in favor. There's just one thing. How much money does the central counterparty have? Because unless the counterparty itself has a huge stash of cash, it's basically taking on everyone else's risk on the assumption that the risk has been efficiently passed around the system. But if the risk is being efficiently passed around the system, why would you need a central counterparty? The creation of a consumer financial products agency. It's great. Look, really, it's a wonderful thing. I totally adore the people who are trying to do it. I think it's absolutely fabulous. And it's great that you'll no longer be able to charge 9,000% interest on your firstborn child on a credit card. It's wonderful, right? And the ARMs will actually come in a simple form and people won't sign up for stupid mortgages. It's great. And it'll do absolutely nothing for over-the-counter derivatives or any source of interlinked systemic risk. So you can focus on this because it has real constituents at the end of it, real people who show up at congressional hearings and tell stories about how they lost their home. And everybody likes that. And you try and explain invisible counterparty risk, good luck. Doesn't sell. So what else are we going to do? We're going to double the SEC budget. That's good. You know the SEC is actually funded with a Tobin tax. You know that thing you're not actually meant to be able to do? A transactions tax. It's actually funded with that, yet we can't do it. It's very weird. We're going to register hedge funds with the SEC and reduce the number of regulators. All great. The Dodd bill is going to have a single regulator, but it won't, and it probably will be passed with some combination of the above. And then Paul Volcker comes in to end proprietary trading, which is 5% of the work of European banks, for example, and about 12% of US banks, and that's the really exposed ones. And then limit their size without doing anything at all about the shadow banking sector. The UK reform proposals are much clearer, which is to say we're going to take a system that didn't work. It completely failed. We're going to have the Financial Services Authority to basically monitor the banks and have no enforcement power whatsoever. And then you're going to have the Treasury that sets policy and the Bank of England that sets interest rates. We're not going to talk to each other, and we're going to strengthen the same system. So we're going to have wind-down resolution, living wills, couple of good ideas, counter-cyclical capital buffers, which will then violate everything that's signed into the Basel II agreements, so that won't probably go anywhere, and limit leverage. Well, you might be able to do that if you own the bank, but if you don't own the bank, which is why the Brits own the banks, you're going to have limits with this one as well. And finally, break up nationalised entities and a Tobin tax to pay for the whole thing the minute all goes wrong the next time, which is Gordon Brown's big proposal, which is really amazing if you think about it, because basically Gordon Brown at this point has said, we know it's going to happen again, we know you won't play ball, we know you can't put you back in the box, so what we're going to do is can you just self-insure? I mean, we're talking about 0.5% on all transactions. Can you just pay your own insurance? And what was the answer? Tim doesn't think it's a good idea. So what do such proposals presume? A risky world or an uncertain world? Now, I know you've read Taleb's fourth quadrant, so let's put it in terms of this. Quadrants 1 to 3. The world is somewhat normal. The jumps are somewhat random but containable. The past is a reasonably good guide to the future. And in fact, we've learned from the past, and that is a really important part of information set, and that's going to enable us to do better the next time. The world is equilibrial, linear, exogenous, in its causation, normal, and causality is efficient. Or it's the fourth quadrant, deep disequilibrium, deep endogeneity, non-normality, nature jumps, and emergent causality. So let's have a look at the problems of the US and UK objectives, presuming a world of risk. Let's assume that the world is tractable. Let's assume that it is computable. Let's assume that all of the nice stuff that we want the world to be like really is true. This is still piecemeal. This is still patchy. This is performative. It's about doing things that people can agree upon. We've got a bipartisan consensus on this. That usually means it isn't worth a damn once you've got bipartisan consensus on it, because it means nobody's going to get burned. It's intended to restore the status quo ante with safety seats once liquidity is back in the system. Nothing has changed from the original diagnosis back in August 2008. Look at the UK ones, more fundamental but contradictory. Tougher policies in the same failed institutional framework. So what do? You rebuild the same system after capital injections. Exactly the same as the original diagnosis. If these guys were doctors, I'd be deeply worried. And the EU proposals, these are truly insane. 3 new out of 7. You have to realize what the EU did before on finance. The whole point of the EU financial reform committees, the 7 of them that were there before in charge of different aspects, had nothing to do with reforming finance or regulating finance. They were there to do what the EU does, to integrate. That's it. That's what the EU does. It exists to integrate. So when you put them all together, and you're going to have one for regulating insurers and one for regulating banks and one for securities, let's just think about this for a minute. The Britain's in the EU. You have this giant pan-European regulator that supposedly has this panoptic power to see all of the assets, all the liabilities, all of the positions of all of the banks in the whole capital space of the EU from Romania to Ireland and back again. And it's going to have the monitoring capacity, let alone the interpretive capacity to figure this out. And it's going to turn around to banks in London and tell them what to do. No, that's just not going to happen. First of all, this is all advisory. So the idea is that they're going to have an advisory capacity. So far, nobody's really asked for their advice. Second one is they're actually going to be able to see all of the risks in the system. And I'm going to talk in a little while about why that's actually completely impossible. And that's why I call them the Jedi Council. But think about what they're trying to do. It's a model that worked for the IMF. It's a model that worked for independent central banks. Worked in inverted commas. Which is to say that transparency and monitoring alone will restore confidence. And this is very much, I think, the German influence in the whole EU setup. Plus the fact that Germans like to blame hedge funds and complex instruments for no apparent reason. Possibly because they don't like blaming countries because it makes them look bad. They do have a really wonderfully interesting, if you read the German press actually, I mean, the way that they spoke about the crisis, there's incredible risk aversion that comes through. So the biggest risk you can do is to put more money, you know, Gresham's law, good money after bad, right, is basically the argument there. But then you point out that, like, okay, think about Greece, right? This is 2% of European GDP, total space. And your banks hold 4% of GDP in Greek bonds. So if you don't bail them out, you're going to end up paying twice as much to bail out your banks. They know this. They won't do anything about it. It's completely ideological. So, again, back to these targets of reform. Let's develop a Consumer Product Safety Commission. That's what the US and the UK want to do. I said, well, that's probably not going to work. Instruments, focus on instruments in France and the US, a focus on positions as a proxy for systemic risk. That's the EU Jedi Council and the UK Council. And a focus on hedge funds, short sellers, and micro-states, people you can beat up in Germany and France. And let's think of the model, still in terms of a risk-based world, let's think about these proposals as off-model risk. Well, here's the really scary one about the Consumer Product Safety Commission, because this is exactly what I would do. If I knew that there's an organization out there that tells me that there's a set of products in the world which are safe, and there's a set of products which are unsafe, you can bet that I'm going to pretty much figure out by backfitting all of the information about products that are safe what the ratings model looks like for making things safe. At which point, I'm going to turn around and take the biggest pile of crap I can and turning into a multi-tranche security and get it rated by the new government agency as being exactly the type of stuff that should be sold to widows and orphans. And I'm then going to sell it to widows and orphans and create the next AIG. Why wouldn't you? A focus on instruments alone. There has been, according to Reinhardt and Rogoff, if I remember correctly, is it 87 or 88 financial crisis since 1720? Something like this? As far as I'm aware, only one of them has involved the use of credit default swaps. So a nice way of thinking about this is imagine you saw the following headline, murder by butter knife. Well, clearly you would say, well, that's a bit ridiculous. It's not as if the butter knife committed the murder. Obviously, the person holding the butter knife committed the murder, right? So this is the guns don't kill people, bullets do when they're in the hands of people who believe that government's a conspiracy run by evil people, right? That sort of thing. I actually subscribe to the Tea Party Nation's newsletters. It's amazing. They're all gold bugs. Really, they actually all want a restoration of the gold standard. It's completely brilliant stuff to read. It's wonderful. Anyway, sidebar. Problem with this. Instruments like knives are not born with original sin. They can be put to many, many different uses. And we've managed to have huge financial crises before without the use of these particular types of complex instruments. So maybe picking on a credit default swap, which is simply an insurance contract with an embedded option, might not be the way to go. Because you can ban one, and I can go into the cash markets, and I'm an amateur at this stuff. I can go into the cash markets and replicate a series of trades that will mimic any complex instrument that you do as an over-the-counter custom trade. This makes no sense. Positions as proxies. It's what I meant about emergent causality. This is where it starts to get really scary, and I begin to doubt that the risk-based world is a good way of thinking about this. So imagine a CMO, collateralized mortgage obligation. You're all familiar with the phrase safe as houses? For years, we've been securitizing mortgages. Incredibly safe instruments. Everybody loaded up on them. That's why we have Fannie and Freddie and all social housing, the whole thing. It's great. It's wonderful stuff. Nothing wrong with these things at all. So here's a CMO. Here's a credit default swap. What a brilliant idea. Somebody out there is willing to take the risk that you, as a company, might default. But really, I know what everybody else thinks of you by eyeballing your share price, and the chances of you defaulting is incredibly small. But you could sell that risk, or you could sell that risk on her, and get an income stream from me, and then I could offset that risk by selling it to you, and then guess what happens? I've just lowered my capital adequacy requirements in the Basel grades. So I can have less tier 1 capital, which I can go out and make more money with. This is brilliant, and everybody's holding everybody else's risk. I mean, it's not as if the whole system's going to fail at once, right? Right? So what happens? Safe as houses, an insurance policy. All you need is a change in the one thing that you can never control in your own portfolio. Not credit risk, not default risk, market risk. The risk that all other positions in the market turn against you regardless of your positions. This turns into a bomb, this turns into a fuse. No one ever designed them to be explosives, but they ended up being financial weapons of mass destruction. Now, what do you do then? There's no intention. There's no linearity. It happens so rarely that the possibility of picking it up in a model, even as a possibility, isn't there. And yet when it happens, it can cost $4 trillion. Where's the risk function? And then finally, hedge funds and short sellers. This is just nonsense. This is like going for the easy one. Well, short sellers are bad. I mean, imagine making money on the downside. Well, imagine making money on the upside. I mean, what exactly is the difference? Is it a moral claim? Well, no, really what they're doing is they're taking good companies and blah, 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 the rest of it. We've been doing this since time immemorial. What do you think a leveraged buyout is? One of the great uses of credit default swaps, this is a little business tip if anybody wants it. If you want to do a leveraged buyout like the Glazers did with Manchester United, brilliant way to do it. Buy a boatload of CDS protection on the target. Right? Then what happens is, of course, that its CDS numbers go up. So what happens to the cost of its debt? Goes up. This knocks onto its share price. Your ability to do a leveraged buyout just went up exponentially with very little credit outlay because all you're buying is default protection. Go ban that instrument. I'll find another way of doing it. Short selling is part of the equilibrium mechanism of markets, and it also ignores the fact that there has to be a counterparty. Somebody out there is going to lose when you gain, which means that short sellers sometimes lose too. So what, sorry, wrong way. There we go. Now, less obvious problems with this. So I call the problem of modeling a casino in a war zone. The limits of value at risk. You probably read some of this. I think it's in your syllabus. There's basically three problems: tunneling, serial correlation, and tail risk. VAR basically takes positions at the end of the day and sums them, and then basically looks at divides up by the volatility of the returns and comes up with a number. And that number tells you if you're out or you're in. It's as simple as that. And it's a brilliant, brilliant piece of technology, and it actually works 100% of the time. That's not the problem. The problem is, while it can sum any individual bank's exposures, it makes the following assumption. Risk is a property of an asset. And if the asset is correctly hedged, then the risk, in a sense, goes away. And that's true within the portfolio of a bank. But what happens if you're all invested in the same asset class at the same time? That means that my assets are the same as your assets, your hedges are the same as my hedges, and we have a serial correlation in the super portfolio of banks' assets. Now, we all implicitly know this, but how does that show up in an individual VAR model? Well, it doesn't, because I don't have access to your books. So we can all invest the same way and hedge the same way, which isn't a problem, so long as I need to unwind really quickly. Because if I've got the same stuff on my books as you have, and we all hit a bump in the road at the same time, what happens? That serial correlation that's really great on the upside, Jesus, can you believe how good property investments are? Suddenly becomes a real problem when you combine it with mark-to-market models at the top. And then you have tail risk. Basically, everybody's tunneling as looking at one part of the portfolio for where the risk is, but the risk is actually embedded with everybody else's portfolios at the same time, and you can't see this. So you look at this one part here, meanwhile the tail risk is extending out exponentially. What does this tell us? This tells us that the world is really neither ergodic nor Turing computable, and I'll give you a very simple explanation, a very simple example as to how this works. So let's see, USA. I'm going to give you a time series exercise. 2, 4, 6, 8. What's next? 2, 4, 6, 8, 10, 20, 50. That's great. 2, 4, 6, 8, 10, 20, 50, 100, 250. 500, that's exactly what I was thinking. That was brilliant. Right, here we go. 3.1415927. Yeah, I know, it sucks, isn't it? 6.117. Bog standard, weirdo, irrational prime number-ish thing. Right. See, Cantor, the mathematician, figured out something really, really cool a while back, Cantor's paradox, which is that the set of irrational numbers is infinitely larger than the set of infinite real numbers. Sounds impossible, but is actually true. And what that means is if you're sampling on that first time series, that time series has information value in it. If you have a time series of irrational numbers, it's noise. There's no signal. There's no way of computing from one to the next, to the next, to the next. That's why the financial world divides into two things, models on the one side and charts on the other. Chartism is astrology. Don't ever let them tell you anything else. Now, how do we know the world is uncertain and not risky? The problem of hidden generators. I'll very quickly run through this. I did 35 interviews during the course of the crisis in the first 9 months, everywhere from London, Boston, New York, Washington. And here's some great quotes that tell you why you can't actually put this into the reforms and deal with the world of risk. First one, it's not the amount of the bonus, it's the damage the bonus system generates that's important. The European Central Banker. This is the moving average problem once again. If I know that I only going to get paid by beating the average, I'll beat the average. The only way I can do this is by increasing the risk in the portfolio. If everyone else does it in the same asset class at once, it doesn't show up in the risk numbers. Everyone thinks they're safe. They're building a correlation bomb. Second one, the math doesn't work. Why doesn't the math work? Exactly as I told you. This is the problem of modeling a casino in a war zone. You don't know where the bombs are. They're going to go off and disrupt your models. Third one, this is great. Even Texas isn't Texas anymore. The rating agencies' models, which the government mandated one of them was published in 2004, thereby telling everyone how to game the system. I mean, really, could you be stupider? Transparency. They're calibrated to the Texas default data from 1985 through 84 through 86. Basically, the last time there was a big housing bust in the United States was in Texas after the S&L crisis. What was the worst case scenario? 40% recovery, 60% recovery rate. You lost 40 cents on the dollar. So you stress your models out to 40%, and you say, hey, it can never get worse than that. Look what happened in Texas. And also, when Texas went down, New York didn't go down, and California didn't go down, so it doesn't make any difference. These things are independent statistically. They're not correlated. Well, we got over that problem by inventing tranches. Because in tranches, I can take a little bit of the Upper West Side of Manhattan, a little bit of Alabama, and a little bit of a mobile home in Florida, and put it all together and make sure the entire thing is correlated, so when liquidity disappears, the CDS fuse goes off and it turns into a bomb. There was no way of seeing this coming. Knowing this, gaming the rating agencies was easy. These are the hedge funds that made a lot of money in the crisis. Essentially, I make bombs. Because I've reversed engineered what you think is safe, and I can make a multi-tranche thing look safe that's filled with crap and sell it to widows and orphans. It's called AIG. And then finally, the world isn't normal in 100 years of data. Why not? Well, the argument is, well, we didn't have a blow-up for 10 years. We're only using 10 years of data. If we'd had more data, we would have known. Well, that presumes that all the stuff about more information is better than less and all the rest of it. A very simple story as to why this can't be true. In 1933, American banks got deposit insurance. At that point, they ceased to be the same things as the American banks that exist until that point. When you put regulation Q on them, they behave in a different way. When you put regulation Q in the trash in 1980, they become different things. You can have 100 years of data, 50 years of data, but unless you know where the structural breaks in the data are, you're not actually looking at banks. You're looking at a thing called a bank, a thing called a bank, and a thing called a bank, which are totally different. None of that information is in the data itself. You have a model of what a bank should be, and you're calibrating to this data. That is making you more blind as you go along. So, why does all this create problems? Fallacy of composition, blindness to the macro. Well, if you think about the ideas that we base finance upon, efficient markets, rational expectations, the only thing you should ever really worry about is moral hazard, right? Because banks obviously are the best people to bear their own risk, and they can calculate it using all these models that we've talked about, and clearly that works best, so just don't bail them out. And that's exactly what we tried with Lehman, and then the whole world discovered what a CDS was. Model homogeneity and tail risk, the problem with tunneling, etc., as I talked about before. Risk is not inherent in an asset. serial correlations and upswings and downswings, hidden interlinkages, the daisy chains. I pass off risk to you and then I sell it to you and you sell it to me. It's not actually going anywhere. All it's doing is collecting everybody in the same chain of risk. It's not disappearing. This is a fallacy. So when you hear today, you see it in the FT letters page all the time, CDS traders talking about how this increases liquidity and I'm able to offset my risk. You're not offsetting it. You're just giving it to someone else and hoping that they blow up instead. It's not doing anything in terms of actually changing the risk profile of the portfolio. And finally, you end up with a problem whereby moral hazard goes systemic, because you used to have 9 banks and then we got rid of a couple of them, and basically now we have, really depending on how you count it, 4, maybe 5. So we've created a system which went from being too big to fail to too big to bail, because we've spent all this money bailing them out, and now if they go down again, there's nothing left to do it with. Particularly in the British case, because having spent, in real terms, 25% of GDP bailing out their banking system, they're going to have to, over the next 10 years, have a 12% reversal in GDP just to keep a constant figure of 60% as the debt to GDP ratio 10 years out from now. That's a huge consumption loss for the British consumer. I'm really glad I no longer live in that country. If I could short the United Kingdom, I would. And in fact, I do. It's called my British bank account. So if you can't regulate what you should, you regulate what you can, and you build them a bouncy castle. So what does it look like to build a bouncy castle? Well, this is what we've done to date, and it's really quite embarrassing when you start to list it. The first thing you do is you relax accounting rules so you can bring back mark to model rather than mark to market. Now, the interesting thing is on the upside, everybody loves to have mark to market, because then you can book it and bank it immediately. It goes right into your profit and loss statement. It goes into your bonus. When you're going down the downside, oh, good God, no, these are horribly undervalued assets. We need to just basically make up the value according to a model that says when I bought them 10 years ago, they were worth something. I love that. I keep trying this one on with my wife. I'm like, no, really, this Chateauneuf de Pape was worth $100,000. Honestly, all right, fine. Add endless liquidity or recapitalize. Create stressless stress tests. Remember the stress tests? They were done using the bank's internal models. You know, the ones that had done so well in getting us to the crisis? And then don't do them again once they fill benchmarks. I don't know if you remember when unemployment hit 10%, you were meant to do the stress tests again. Shh, didn't happen. Turn the central banks into bad banks, pump the stock markets with repos, don't really limit leverage or compensation, admit you can't do anything and insure it, which is a Tobin tax proposal which they don't want to do anyway, and then keep housing tied into life cycle earnings and start the machine all over again because you don't know what else to do. Now, can we do different? Yes. This is really, really simple stuff. Complex systems are only governed by simple rules. You can't have complex rules in complex systems. It intervenes too much. It blows up. So what are the simple rules? Counter-cyclical capital charges tied to asset class growth. This is the easiest thing in the world. But if you have a central banker that says, I can't see an asset bubble when it leaps up and says to me, I'm an asset bubble jumping out of an asset bubble cake, that's obviously not going to happen. Unlevel playing fields. There's a wonderful argument made by banks, big international banks, that by having the same rules everywhere, you lower the cost of capital, and that's better liquidity, and that means everybody gets better returns. Bullshit. What you need to have is lots of local rules, whereby there are these things called democracies. Remember that? People get to actually vote over the allocation of resources, even through proxy institutions like banks. And if they decide that they don't want all their money going into houses at one point, then it's perfectly acceptable for them to say to banks, local or foreign, you don't get to do this. And if that means at the end of the day, oh, but you've got to watch out for regulatory arbitrage, because if you have big rules and someone else's weak rules, all the banks will go to them and there'll be no regulations and they'll turn into Iceland. Good luck with that. We've seen what happens when you basically have a risk management system that involves running naked through the woods. It doesn't end well. An end to self-regulation by risk models. VAR is wonderful. It works so long as you're the only bank in town. The minute you're not and you're playing with all the other boys in the pen, it doesn't work anymore. So use it, but realize its limitations. This is what I mean by Keynes' expectations. Your expectations are not rational, they're myopic, short-term, front-loaded, and extremely weighted. And if that's the case, don't expect any kind of assessment of risk to tell you what the world really is. Limit size and leverage. Canada didn't have a crisis. It has leverage limits. Norway didn't have a crisis. It has leverage limits. Size is really easy. If you have 4 banks and one of them goes down, we'll all die. If you have 400, one of them goes down, nobody cares. This is not rocket science. And finally, aligned risk capacity and risk trading. It is insane to have a pension fund with a hedge fund embedded in it. They're borrowing long. They're borrowing short. Don't put one inside the other and confuse the capital streams. One of them will end up blowing the other one up. The AIG experience. If you're a bank, behave like a bank. If you're a hedge fund, be a hedge fund. Don't confuse things. Keep it simple. And why do we need to act now? We need to act now because of structural problems such as 20% of GDP is constituted by finance. 30% of gross value added in the US. There's a big question as to whether any of this actually creates wealth or simply skews income. There's a question of whether this actually has anything to do with talent diversion and moving averages and bonuses. I mean, 40% of you guys are going to go into finance, and 1 in 10 of you, by the time you're 35, will earn between 50 and 60 times the median income. What's the downside? The downside is you people should be going out and engineering our way out of global warming, but you're not. You're engineering complex derivatives. And you'll make lots of money because that's become the only thing that matters. Just make lots and lots of money. And then at the end of the day, you're just as miserable as everybody else with an expensive therapist living in New York. There is no politics. What's it for? What's the point of all this? If you go read Smith, Smith has a lovely section on this in The Wealth of Nations. He says, what is the point of all this activity? He says, to be well regarded, to be held in esteem by your fellow man. Is that what motivates us, or is it just to have more than everybody else? Our sense of priorities have become completely warped in a way that I think is incredibly dangerous. And all of this is predicated, to go back to what I call the new MAD, on the ability to run a global division of labor, where everyone in Asia works for very little money and makes really good stuff that they sell to us, and we swap them bits of paper bearing 2%. That is not going to happen anymore. And the problem for that is the following. The bottom 2 quintiles of the American income distribution hasn't had a pay rise since 1979. What's made that possible is the world's largest corporation, the owners of whom are richer than the bottom 100 million Americans. I refer to the Walmart Corporation. What's Walmart's slogan? Prices keep falling. Not anymore, they don't. So here's wages, here's prices. Prices went down. What happened to the real wage? Just went up. Depression time again, only this time it's good. Because nobody has to give you a real wage increase when that plasma TV price goes down. Nobody has to give you a real wage increase for almost a generation, so long as prices keep falling. But unfortunately, eventually those people in Asia might want to have a real income boost themselves. Or you might start to run out of stuff, and things might cost more. And at that problem, your ability to do consumption smoothing through debt instruments, i.e. give everyone and their grandmother a credit card to do individual Keynesian deficit financing, might run into a big problem. And that's where we are. And the idea that we're going to just start up the machine again isn't going to happen. And we haven't quite got back to that yet, because we still think this is about liquidity, capital, and confidence. So why can't we reform like we did in the 1930s? Very simple. Finance is the most powerful lobby in Congress. Forget AIPAC. Forget the old people. Forget the gun lobby. They outspend everybody 2-1. The lack of an alternative paradigm. Keynes is back. Well, yeah, in Joan Robinson's language, bastard Keynesianism. It's not about short-term expectations and the management of investment certainty. It's about pumping money into the economy. And when you pump money in, people monotonically respond, right? Well, the rational expectations critique did have some kind of validity, actually, in terms of the way that that model goes, because that's what Keynesianism was never about in the first place. The Demerone problem, is it dusk or dawn? Everyone wants to think it's dawn, but it might actually be dusk, in part because no one's had to take any losses yet. The only people who are going to take losses are taxpayers. That's why you have the Tea Party people. Don't laugh at them, don't fear them. You should take them seriously, because they know that they're going to be paying for you when you're lapping it up with 50 times the median income. You're too big to bail. And the people who are meant to regulate you have no incentive to, because there is absolutely no downside to the upside of a bubble. So think about Clinton. Clinton managed to have a balanced budget for 2 data points, which we then pushed into the future for forever, and then it all fell apart because there was a black swan called 9/11 that came along and destroyed it. But that notwithstanding, when you're on the upside, doesn't it just prove the wisdom of my incredibly good economic policies? Aren't things always better with me, even if it's got absolutely nothing to do with me because it's a global bubble and Bill wasn't in charge everywhere at the same time, despite what he thinks? So if this is the case, we can't reform. We're stuck. We're building the kids a bouncy castle. And this time, there's 4 of them. They weigh 300 pounds each, and they're heavily armed. Good luck with that.
I think we should take questions, comments.
Could I start with a question? Actually, there's some ambiguity in the programmatic implication of your argument, which is that in one respect it could be read as suggesting a therapeutic nihilism, given the political constraints, and in another respect as suggesting another course of action. So I'd like you to speak to this apparent ambiguity and to tell us what policy with respect to the crisis you would support if you were President of the United States.
Sure. The ambiguity is not apparent, it is real. There is a therapeutic nihilism in it. I think you have to have a sense of humor if you study this, because the numbers involved and the losses involved are shocking. And when the real costs have not truly been felt by those who caused them and are instead pushed around the system to become someone else's problem, it helps if you have a sense of humor. In terms of what we should do about it, number one, I think we should have really, really powerful government auditors. The SEC is meant to do that. The SEC is run by a tiny little Tobin tax, doesn't have enough inspectors to really do it. But we should be able to go in and find out all the proprietary models, find out all the risks inside the bank, and then try, even if it's difficult, even if it's probably impossible, to do the calculation of super portfolio risk and try and figure out what systemic risk is. Doing this with some self-appointed council of worthies, voluntary reporting through the banks, through the BIS, is never going to do anything. So some really serious supervisory regime. But that would be still within the camp. That would still be working on transparency and information enhancement as self-stabilizing. Let's be a little bit firmer than that. Let's break them up. 4 banks, 5 banks, 6 banks, this is lunacy. This is absolutely crazy. I mean, we're meant to like competitive markets, not oligopolistic markets, right? There's no competition in this. This is a clique, a cabal. This is anti-democratic. You don't even have to go into the income skewing to see this. So let's break them up. In terms of the shadow banking system, which is as big as the real banking system, why do we have all these special purpose vehicles and special investment vehicles and off-balance sheet risks that nobody's aware of? Well, because you can. All right, fine. In short, let's do what Paul Krugman suggests. Let's make finance boring again. Because the interesting thing is, and I've got a student of mine, I'd hoped to have it today, but it wasn't ready. I've got a student of mine working on a graph from the Reinhardt and Rogoff data set on financial crisis, which the problem is with that, you basically have to do inflation-adjusted dollar calculations for countries that no longer exist back in the 1700s, so it's difficult. But essentially, if you basically do time against frequency magnitude, what you find in the data is the following. Relatively small, randomly distributed, building up into the 1850s, 1860s, a couple of spikes, then you get the Wall Street crash, and then you get practically nothing. There are practically no crises in the post-New Deal period through to 1975. Let's remember what was going on then. This is when they had the Wirtschaftswunder, the German economic miracle. This is when the French not only doubled, they trebled national income in a 25-year period. This is when the Italians, of all people, right? We're talking about the joke economies of Europe. This is when the Italians, of all people, had il boom. I love that, il boom. So even they had a boom, precisely when finance wasn't free. So to what extent is this really adding growth, adding wealth, doing all the things it's meant to? Or are we just buying, pardon my frankness, a line of self-centered bullshit from people who are making out like bandits? I'm beginning to think that's the case. Very simple rule, counter-cyclical capital charges tied to, basically you would have a nominal GDP target. You have a weighted coefficient linked to a particular asset class. Asset class goes up by X. GDP target is at variance with the asset class. Counter-cyclical capital charge says you need to put more money up in terms of a buffer. This discourages lending in the center and then pushes it out to somewhere else. It's the easiest thing in the world. But when you do that, you are intervening directly in what finance can and cannot investment in. And that becomes politically, not economic, extremely difficult. So there's plenty to do. And if I was giving pure authority and carte blanche, it'd all be done tomorrow. It'd be very simple. But I'd probably be dead first.
I was wondering, when it comes to this issue of stagnant real wages and inequality, how do you propose dealing with it without getting the tax and transfer system into question? When it's kind of hard to say that like the low-skilled American worker is 30 or 40 times more productive than an equivalent worker in Asia. So I mean, obviously there's a long-term project of like building educational skills and work skills generally. But I mean, do you see any other way of dealing with stagnant real wages?
It's an extremely difficult problem for countries such as the United States and the United Kingdom. Less so for countries such as the Netherlands and the Scandinavians, and even the Germans. Number one, they have bigger tax and transfer systems in place already. They actually redistribute, right? So there, you've got to start. The second one is what I like to call the dirty little secret of labor economics. You don't need people anymore. You really don't. So think about the American economy. It's 78% services, 10% government, 12% manufacturers. So we get all bent out of shape about manufacturers. But it's not as if the manufacturing has stopped. It just went elsewhere. It's a global division of labor. There's plenty of Chinese peasants who are now industrial workers who have got higher real wages because of it. We're all in favor of development, right? So isn't that development? Hate to sound like a neoliberal for a moment, but that seems to be the case. So what exactly do we do with all these American workers then? Well, basically they become hairdressers, burger flippers. What's the fastest growing single occupational category in the United States? Elder care nurse. What do they get paid? Minimum wage. Now, two reasons for this. Marginal productivity school will tell you that because you can't add capital to service sector jobs, you're going to end up with low wages. Right? So you can't give hairdressers a giant pair of motorized shears and do 10 heads at once and make them super productive, right? There's something to this argument. But there's another way you can do this. If you go to Denmark, you will find that it costs $15 to have a Big Mac and a Coke with your friend. Not 5, 15. What this means is that the social charges on employing someone there are extremely high. So they're actually getting a decent real wage, which means that their consumption maintenance is actually quite high, which means that people eat less McDonald's so they look like Danes and not like some Americans. So there's negative, positive externalities to this whole thing. I mentioned that as an aside. It's true. I noticed this when I was in Denmark. But anyway, the point is, if you have a political consensus or a political project whereby saying that elder care nurse is something we as a society should do, that should be regarded as a skilled job, that it should be recognized, that there should be, God forbid, trade unions involved in this thing, then there's a way of transferring resources in such a way that this becomes consumption maintaining in a de-skilled service sector environment. All of the advanced capitalist states are facing this problem. Service sector's growing, it's where the job is, it's low productivity, it's low end, and it's going to be low wage. The only bit that's got any money is where you guys are going to work. Now, what's the problem? The problem is, should I come to you and then just take your money? That's not going to work too well either, is it? So there has to be a political discussion about how we deal with this secular shift out of manufacturing towards services. Because frankly, the most productive people in the world are the Swedes. Their labor productivity is off the scale. Why? Because they work with more capital than anybody else. The only problem is, in that little Volvo factory in Uddevalla or wherever it still is, there's only 4 Svens and 1,000 robots. You only need 4 Svens, not 1,000.
Do you think we're headed for a double dip recession despite sort of some signs of improvement? There seems to be a lot of noise in the background about that. I'm not sure how much attention we should pay to it, but it's there.
Given everything I've said, I'm the last guy in the world to make a prediction. But I will. I won't. I really don't know. I have absolutely no idea. I mean, I could come up with 20 different stories that will go one way or the other. And it might all turn out totally great, or it might not. And I really don't know. This is profound. This is one of these, to go back to the whole notion of uncertainty, this is one of these really interesting moments of uncertainty where everyone's certain that it's not uncertain. Nothing really bad has happened, but we know things have screwed up. So now we're all sort of like gingerly walking, just hoping it'll all kind of come back together. Hence the very piecemeal reform efforts, etc., no big projects, so on and so forth. There's a kind of, that's global reform. So how does this get any better? Unfortunately, things get better when things get really worse. And if you go back to what I said about the 1930s, when things got really, really bad, they didn't get better in most places. In most places, they got really, really bad. Most policy responses to economic collapse involved impoverishment, invasion, and death. Let's not go back to that. That would be really horrible. It's what I always have to break with my European colleagues. Because basically most European economists, when you scratch them and get them drunk, are Trotskyites. So they're actually all waiting for the great collapse and everything to end. See, finally capitalism. And then you have to remind them that this might cause a couple 100 million casualties. You know, we need to think about this. So I don't want things to get worse. But as to the actual direction, I really don't know.
You mentioned the unlevel playing field concept with Iceland, et cetera. If we make finance in the United States plain vanilla, how do we prevent the fact that they can then just circumvent that globally?
And then, it's a great question, and it is, you know, the fear in that sense. You need to have multilateral cooperation on one level, right? And that level is simply common standards. Now, that can mean everything, and it can also mean nothing. What do we mean by common standards in banking? Well, it has meant Basel I, Basel II, etc., which has led to banks effectively becoming their own regulators. Probably not the best idea. Why would an unlevel playing field, this Warwick Commission idea was involved with, be a good idea? If you want to become the next Iceland, go ahead. And when you blow up, none of us will bail you out. Seriously, take all the risk on your books. Go for it. Absolutely do it, because there will be a bust. There's the one Minsky's insight, which is absolutely true. You cannot have a bust without a boom. So if we're going along plain vanilla, maybe making money in emerging technologies, maybe actually investing in things that you can buy, sell, and drop on your foot, how dreadfully old-fashioned, and somebody else wants to do all the exotic finance they can and then basically turn their country into a large champagne bar, knock yourself out. It will end. And when it ends, don't come crying to me. So I think that should really be the policy stance on this one. The second one you can also do, and this is the one the Germans talk about very quietly, is maybe we just won't give your banks access. So if you set up there, you just don't get to play here because we consider you a liability. It's really easy to do. It's just a political question.
And so do you think that that's politically possible, given that if you see your neighbor making millions of dollars more than you are because you're being responsible and they're not, I mean, that seems to be the problem with, Dubai or whoever is going to be making so much profits. And if it's such a small country, then they can probably pull it off for years and years and years before it goes wrong. How do we maintain a level of responsibility, a sense of responsibility, and don't go into that sort of thing? It seems like there's just this, the grass is so much greener over there that we don't want to move.
Absolutely. However, the question is, the grass is greener for whom? In which part of the population? Go back to the 1930s again. Roosevelt had no problem at all being called a class enemy by his own people because he basically made them the enemy. And people believed that they were the enemy, that they needed to be put back in the box, that it had to be tamed. It was a good thing to do so. Now, if you do that, why would you want to go down that road? So I'll give you an example of this. In Norway just now, Norway is the United Arab Emirates of the Northern Hemisphere, right? Basically, they pump money out of the ground. It's the same population as Brooklyn. So they pump money out of the ground, simple as that. And politics is really boring because they have a huge fund, unbelievable social services, taxes, transfers, all this sort of stuff. It's the social democratic nirvana, and consequently boring as hell, which is why I don't live in these countries. I much prefer the United States. I like a bit of uncertainty in my life. But anyway, they have a party called the Progress Party. And the Progress Party is the let's spend all the oil money now on a huge piss-up party. That's basically it. And they do get about 16 to 20% of the vote because a lot of people are like, yeah, I know that I've got free healthcare and education and everything else and it's all great, but I want more now so I can have. You kind of have to trust to a certain extent the innate rationality of the public. Now, that's a big gamble in some places, I know, but some countries show that they don't necessarily fall for the next get-quick-rich scam in that sense. And the way that you do that is by creating a healthy bit of class ressentiment. I mean, after all, if you're talking about 4% of the population making off of 40% of the returns, it's pretty easy to do if you set to it, but that's class warfare. We don't want to do that. Strangely, every time I switch on Fox News, I see class warfare against the bottom end of the income distribution. Nobody seems to mind that one.
You laid out a very good sort of, I think, rational program for trying to deal with all these things. But what you didn't do, and Roberto phrased it very nicely, so if you were the king and you could just enact your program, but then you are in a world where you said the banks have, finance is the biggest lobbyist. Mm-hmm. You just mentioned Fox News. And so say you were, instead of being the president, but you were a political leader and you now had to figure out how could you move in the direction that you want. So what wisdom would come from political science or from you in any way, shape, or form on how you would do that?
The words wisdom and political science are not often found in the same sentence. So I will try and recompute that. Being Scottish, I get to say I'm a political economist because we invented that. It's great. It's a proprietary claim. It's really difficult. Here's a little story. Here's an explanation by way of an anecdote, right, which are often better than mere facts. So I had a friend who was at Davos, who will remain nameless. And my friend came back and said, so what was the word at Davos? And I says, well, the interesting thing was, for the first time ever, all the Asians were lined up the one way. I mean, what do you mean? Well, the Japanese don't trust the Chinese hate the Japanese, nobody speaks to the Burmese, all this sort of stuff. It's all weird. And this time, they were on message. And there was one message, and it was all directed at the United States. Oh, really? What was it? Basically, we don't really give a crap about your debt, because we know that your tax take of GDP is 18% and you spend 30%. It's just a question of paying more taxes, right? That's fine. You can do this. You can be Pakistan, you can take 13% and spend 20% and your society breaks, or you can actually just pay for things. That's what you need to do. That's not a problem. And, you think we have deficit and debt, and, we're really not a problem about these things. It's not a problem. We really care about your democracy because we think it's fundamentally broken. You see, you criticize us for being authoritarians, but when we spend for deficit spending, it starts and it stops. You can't even get your projects out of the Pork Barrel Congress. And then you whine about how much money you haven't spent. You're about to elect, or there's a possibility that your main opposition party, which now seems to be the party whose main policy is do nothing at all ever, just piss off the other guy, might elect someone who is basically a weather girl to be president. And this is scaring the crap out of us. And this was the story that came back to him and many other people time and time again. We don't care about your debt. We don't care about your deficit. We care about your democracy. We think it's fundamentally broken. Now, what's one of the mechanisms by which they're getting out of this? Well, one of the problems, which I didn't really spend any time on, is the whole issue of East Asia is sitting on $2.5 to $3.1 trillion, which basically might rapidly devalue at some point. But the problem is monetarily assured destruction. If I try and get out of these assets, I cause the devaluation I'm trying to avoid, and then we both end up dead, right? Very simple story. There's an interesting thing going on just now. The United States is renegotiating its bilateral investment treaty with China. Very quietly. First meetings have taken place, moving forward. What do the Chinese want? Well, what's China allowed to buy? Paper. What do they want? Real assets. Pharma. Military companies. High tech. Banks they're taking a pass on. But they want to buy things with actual real value. Now here's a creative way of thinking about this. Imagine that as a sterilization facility. Imagine that they do an Abu Dhabi Investment Corporation strategy where they get to own 0.5% below reporting requirements of everything. Spread right through the whole economy. We get the dollars back, we burn them, everybody's happy. That might give us some wiggle room to get Congress off our back about nonsense claims about currency manipulation. I mean, we've been manipulating the dollar for years and years. It's called the strong dollar policy. They're quite explicit about it. When somebody else has one, suddenly it's a problem. But this might create the type of room whereby we could address some of these problems. But the problem at base is the democracy is deeply flawed. This is not an economic problem, it's a political problem. And it's quite all right, and I think quite justified, for semi-authoritarian countries to turn around and say, you're one to talk.
Actually, one of the distinctions you made there was the line between uncertainty and risk. For Keynes, he draws pretty much the same line. But one thing that he mentions is that uncertainty by itself is not the problem. The problem is when you mix uncertainty with liquidity.
Mm-hmm.
And people, for example, nowadays, money managers are usually their performance is usually measured by their quarter performance. So like they actually want to get returns really fast. Whereas 200 years ago, whenever you invested in a company, you invested in the long term.
You held the stock. You wanted the dividends, yeah.
Yeah, exactly. It was pretty much like an endeavor, right?
Mm-hmm.
And nowadays the system is different because of liquidity in Keynes' opinion. So like, do you think then constraints to liquidity could be, despite of what everybody else says, could be a good thing for the economy?
It's an interesting thought. I haven't really thought about it. My favorite Keynes quote, actually, is about liquidity. You know the line about liquidity? There is nothing more noxious than the fetish that liquidity is the property of a community. I think it's, or just that, or it's not the property. I can never remember what it is, but he says it particularly well. That there's no such thing as individual liquidity. It's a social property. And therefore, my liquidity is your liquidity. If it dries up for me, it dries up for you, and then there's no way back. That's the problem with it. So to me, the uncertainty story fits in with that. But the way I generically think about this, and this is the social sciencey aspect, right, is what are institutions? Institutions are essentially, on the one hand, information rationing devices. They also allow you to have convergent expectations. So in this role of talking to you guys at Harvard University, I'm not going to come in here naked. Right? You can bet that's not going to happen. The institution and norms associated with it will mean that that's not going to happen. Lots of other things are not going to happen. So law, in a sense, is just simply the formal codification of a series of institutions that allow you to get to that point anyway. We don't kill people because of murder. We don't not kill people because of murder statutes. We don't not kill them and then we say it's bad and here's the law against it, right? Now, if this is the case, what exactly is the world? It's a world of risk to the extent that those institutions conform to our expectations. And those institutions allow our expectations to conform. So everything's convergent, it's interactive the whole time. By basically acting within the institution of marriage, you valorize the institution of marriage, that sort of thing. And just scale it up and you get the same problem. What happens when you get uncertainty is the expectations can no longer be realized within the institution. They fall apart. So my first best strategy, my actions, my habits, which have always brought me these returns, start to feed back in a negative way. And the same thing happens for you, and we don't know why. And then you get the coordination failure, the institution fails. That's how you generate uncertainty. It is the exception, if you think of it that way. So normally we live in a world of risk, occasionally we live in a world of uncertainty. But that's actually a stupid way of thinking about it. Because the background condition that generates the possibility of living in a world of risk is a profound and deep uncertainty that we're constantly struggling against and trying to get over. Follow this through, equilibrium assumptions become really problematic because they don't just happen. It's not just like a Nash equilibrium where people stay together because they can't be bothered changing their minds. You have to work at it all the time. Every bit of energy that's put into the system has a piece of entropy pulling against it. And if you think about it that way, it's a much more dynamic, disequilibrial way of thinking about the world. In that case, simple rules, complex systems really begins to make a lot of sense to me. So that's the general way that I try and think about this and formulate this, rather than sort of it's there and it's an information problem. If only, really, if only it were that simple.
I was wondering what you thought of the importance of international standards and regulation. Like you talked a lot about the difficulties and political difficulties of establishing a domestic standard, but I would think that the problems at an international level would be orders of magnitude more, in the sense that we have those political standards and issues to deal with for every country. So I mean, I was just wondering if you had any insight into the necessity for international coordination of regulation.
Here's a little factoid by way of explanation. No international financial crisis has ever been solved at an international level, ever. That's always been what's happened once the crisis is over. So are we looking to the after party to be the shoot? Possibly. These things are solved on a local level. Actions by the British government, the German government. There are international organizations that take a second fiddle role and help these governments do what they want to do. So the IMF in Eastern Europe, et cetera, et cetera. So there are always international aspects and dynamics. And this is, I suppose this is again sort of intellectual confession time. The reason I ended up in the United States, this actually, we'll get to the answer, was I wanted to study international relations because they didn't really do that in the United Kingdom. And I kind of fell out of love with economics, ended up in political science, wanted to do IR. So I got here, went to Columbia, did IR, discovered it was the stupidest field in the world, and I ended up falling back into political economy. And why is it the stupidest field in the world? Because it insists on this thing called the international, which has its own sort of like reified set of causal properties and identities, which I just don't believe in. I just don't see that as being the case. So when I do this, it's always bottom up. So think about international financial standards, Basel regulations, right? Well, why did you write them in the first place? Well, who wrote them? Well, it's the Bank of International Settlements. Who's the Bank of International Settlements? I mean, talk about a case of institutional survival. These guys were set up to pay reparations in World War I. Keynes wanted them shut down, but he died before they could do it. So what do? They invent new things for themselves to do. Think about the IMF. What was the IMF? It was there to provide lender of last resort liquidity for countries that got into balance of payments problems on a modified gold standard called the Bretton Woods system. It's not there anymore. Why is there still an IMF? Because we can reinvent ourselves as the policeman of the system and surveillance and all that sort of stuff, right? So you have these discrete organizational survival properties, and this somehow is a thing called the international. Well, let's think about what happens with Basel. Who are the people that understand finance? The guys in the banks. So if you want to regulate them, why not get an institute that's fully funded by the guys in the banks, the Bank of International Settlements, to hold a conference inviting all the guys from the banks to come along and decide what would be best for them? I mean, really, in Britain they call this a steward's inquiry. It's when like a long shot horse wins and clearly the money was, going the other way. That's how I think about the international in that sense. Do you need international standards? We got by for a long time without them. Think about this one. The Bretton Woods period, its best period was from 1948 to 1958, precisely when it didn't work. There was no convertibility. So precisely when it didn't work, you had the highest period of growth and less trouble. So I'm deeply skeptical of the notion of the international. I think it is a series of vehicles for both state interests and self-interest masquerading as a public interest. Which is why I don't get invited to too many UN gigs, strangely.
We have no other questions.
I know. I have a question for you guys. Where do I get to see the Barcelona-Arsenal game?
Phoenix Landing.
Where was the nearest place?
Phoenix Landing.
Yeah?
One stop on the subway to Central Square and keep walking toward Boston. 1.5 miles.
Oh,
Fantastic.
You do better with the John
That's
Harvard,
what I
think.
needed to know. Exactly.
Okay. We thank you, and whichever of the teams you're rooting for, I believe it's Barcelona?
No, it's not. It's Arsenal. I don't do people who support UNICEF.
I see. Okay.
Oh, thanks, guys. It was a
Okay,
pleasure.
thank you. That was awesome.
Glad you liked it.
Really good.